But in that, I have absolutely more number of losses, right, than number of winners. But if I'm wrong, I have no problem getting out quickly. And if I'm right, and I think a lot of people fall into that trap too, it's the Kahneman Tversky, sort of thing, where, they're risk seeking at the wrong time, right? So let your winners run, let your losers, get out quickly, take care of themselves. And at the end of the day, it's about making money, not being right. I think a lot of people mentality wise fall into that latter trap.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have a special lesson for you. I'm putting it here on the podcast because I really believe that this is going to provide you massive, massive value. And that's what I'm trying to do here. And hey, listen, if this podcast was useful to you at all, I really highly suggest that you go check out the full trading course at AIStockTradingSystem.com. That's AIStockTradingSystem.com. Markets are people. People are predictable. Outlier can show you how to track market fear and greed with artificial intelligence on over 1,300 of the largest market cap names. Visit outlier.com to learn more. That's OVTLYR.com. They have a free pilot program for the rest of 2021 so you can get access to right now at OVTLYR.com. That's OVTLYR.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. So, Tim, that's I didn't get a chance to ask you this. Where is your website right now? Because I've got a few different links, but I want to make sure that we talk about the right place.
Yeah, I have a bunch of them. Probably the best one would be my MarketFi one. And I can
Marketfi.com. Okay.
Yeah.
Gotcha. No, that's why I asked, because I saw you've got Delta Derivatives, MarketFi. You used to be at Trading Block. So I was like, what is this actual spot we need to talk about?
Yeah, and then I'm doing some I provide trade ideas to a couple other websites, multitude of things. And mostly I trade on my own. That's where the bulk of my time's at. So
okay, that makes sense. So, Tim, I saw in your bio that you worked with Man Securities in Chicago. Is that the same Man where Larry Hite was at?
Don't remember. Was he on the futures side probably?
Oh, yeah, for sure. He was one of the market wizards, Larry Hite.
Okay. It was, it would have been the same. I mean, Man Securities was the, redheaded stepchild of Man, because Man was huge on the futures. And then I left there. Basically, they kind of cut out securities. And luckily, right after that's when Corzine blew up the company. So, then I moved on to Thinkorswim after that, and then to Trading Block.
Oh, okay. So, yeah, that was definitely the Man Securities that Larry Hite was at. Yeah, I had a chance to speak with Larry before, so I thought maybe y'all knew each other. I'm from Texas as well. You could probably hear with the y'all.
Okay. I got the Chicago accent heavy, so.
No, it's all good. So you probably knew Tom Sosnoff and the Tasty Trade people.
Yeah, absolutely. No, I mean, Thinkorswim was great, and I would have stayed there except when TD bought them out. Mm-hmm. They didn't allow discretionary trading and stuff I was doing, because TD just wanted to be, the big, broker, right? So I had to move out of there to Trading Blocks, one of the few places that still allows, discretionary trading. I got some managed accounts that I trade for, so I need to have that ability.
Gotcha. Okay. So what are you doing these days over at MarketFi?
Basically, that's my longest running, website that I basically provide trade ideas, educational videos, all volatility based. That's really, I base almost everything off of volatility. Most of my trades are vol arb type trades. So I've been doing that for 7 years now, and kind of morphed out of, I started years ago, kind of providing trade ideas to individuals, not on a website basis before the websites took off. And it just morphed into that. It was so much easier. You can get a bigger audience and so forth.
Yeah, that makes sense. So when you talk about volatility, are you talking like selling premium or what? Is there a different path that you're talking about?
Well, it depends really on where implied vol is, right? I mean,
Yeah.
and I look at basically, for my prop trading, absolutely look for, capturing IV differentials, what I call pumps and dumps in the vol surface, and more kind of a market maker approach. I trade on the floor from 87 to 90. And taking kind of that approach, low risk, you can get into butterflies, long flies for credits, stuff like that. So it takes a lot of grunt work, but it's well worth it because you can just keep grinding stuff out. So that's what I really focus on day in and day out. For the trade ideas, obviously retail accounts can't really do that. So I just look for extremes and take a counter trend position at extremes is really my forte.
Mm. Okay. So now I have to ask, counter trend trading at extremes. I'm writing this down.
Yep. And I wait for the curl, it's called. That's another term I use. So, I mean, if something's ripping to the upside, right, I won't jump in front of it
Okay.
until
Okay.
the market shows me, that, this may be at least slowing down here.
Okay. 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 Because when I hear somebody say counter trend trading at extremes, I think you like to stand on the railroad tracks and just let the trains run over you. Is
No,
what
no,
I
yeah. I may be
heard.
dumb, but I'm not stupid, right?
Look, that's how I cut my teeth in trading, was trying to trade counter trends, right?
Yeah.
And it had a lot to do with the idea of being a quote contrarian trader. And it's, oh, if the market's up, I'm just going to start selling calls against it, right? Which was a terrible, stupid way to
Yeah.
learn how to trade. But in the process, I paid my Wall Street tuition, and now I feel a lot better about how I trade.
Right.
But to your point, you wait for the curl, and that's what I talk to people about all the time. Is if you are wanting to go long on something, but it's been just falling apart, just wait.
Yeah.
And then at some point it will say to you, hey, I want to go back up now. Right. And that's what you're talking about.
Exactly right. And it's I just started a sort of spread service based on that, using a simple kind of RSI and then having confirming indicators behind it. But basically, RSI crossover from above 70 to below, or below 30 to above. Make sure it confirms with maybe MACD momentum. Make sure the technicals, the chart looks good, and then I go one standard deviation out, 30 days out usually. One standard deviation I like is the market's leptokurtic, right? It either moves big or sits there most of the time, and you actually get paid more than what it occurs. So I like to kind of hunt in that space for the spreads.
When you
And
say one
30,
standard deviation, are you saying that you're, for example, if you're going to go short, are you saying you're selling call spreads at the 30-ish delta? Is that what you're saying? Am I reading that right?
it would be somewhere around there, exactly right. It
Okay.
depends, but yeah, so I look 30 days out in time, right? Because I like that. It gives you enough, too short and you get way too much, gamma if it starts going against you. And too far, the thing doesn't move forever. So 30 days seems to be give or take, and then one standard deviation because of leptokurtic. And yeah, to answer your point, yeah, you're pretty much hunting in the same area from stock to stock. Higher implied volatility, bigger cushion, but they need to be.
Mm-hmm, mm-hmm. So when you say one standard deviation, some people refer to that as like a I believe it's like a 30 delta on either side. So that's why I was asking, are you taking like the 30 delta on the call side, or are you going like the 16 delta?
Remember, deltas depend on implied volatility too.
Mm-hmm.
So higher implied volatility, deltas tend to come towards 50. Lower implied volatilities, they go away from 50 more. So you can't use a, exact delta kind of scenario, but one standard deviation out on a 30-day basis, right? You're really looking at take the annualized, and divide it by, roughly 3.5, and that'll get you, the monthly standard deviation, just go
Oh,
above
okay.
and below there, and that's where you're at.
All right. So how do you maintain your risk there? Because let's say you're selling spreads and you're doing it on, 30 deltas, just to be consistent with our examples
Right.
here. You're probably taking in, like, if it's a $5 wide spread, maybe $1.50, maybe $1.25, something like that. How do you maintain your risk? Do you Because some people would say, you know what, you put on a defined risk spread and you just let it run. But the math doesn't play out with that when you've got like a $350 loss, one lot's here, $350 loss and $150 win. Like that, the math doesn't always play out to where that works. And I know, because that's how I lost.
Exactly.
That's how I lost my first fortune, is how I describe it. So how do you maintain the risk on that?
Yeah, I mean, if you look at it just from straight probabilities, right, you're going to have roughly about an 83% chance of that spread going out worthless, right? If you just look at it, because, it's only on one side as far as your standard deviation. You don't have to worry about the other side. So, let's call it one out of five should be maybe problematic. And I usually use a money factor. In other words, if I'm selling the spread, and most of these on a 5-point wide spread, you're looking at about a 70-cent net credit, one standard deviation out. And I like kind of the 1-point strikes now to tighten up the risk, right? Some guys actually gravitate more towards the wider spreads where you're in essence almost selling a naked. It helps margin wise, but risk wise, that long isn't going to do much for you. So I use a money factor. Say we sell the spread for 70 cents. If all of a sudden, it goes 1.5 times against me, right? Where it's trading at, somewhere around, $1.80, then I would be looking to, maybe cover that spread and just move on. And I'm a big fan of just take a loss. Small losses are great, right? Small losses are inevitable. Large losses are unconscionable, I always say. And if you look at your trading career, it's the big losers that define how well you do in the long run, right? Long-term capital is the classic, example of that, right? They were still right about 98% of the time, right? But the Fed had to bail them out. So,
yeah, I mean, you can vacuum up all the nickels all over the world you want, but eventually you could overextend yourself, and that's what happened there. So Tim, I forgive me because I jumped straight into trading mechanics and such here without giving you a chance to tell me about you.
Yeah, so I started my trading career the old-fashioned way as a runner on the trading floor back when there actually, number one, was a trading floor. There's still a few guys left down there, but it's a shadow of itself. And then worked my way up, bought a seat in 87. It started right before the crash of 87, actually trading my own money, which taught me an invaluable lesson. If you were able to trade the day after the crash of 87, right? I mean, it was free money because you're trading against literally risk managers on the trading floor, and they didn't care what price, right? They just wanted the, get me out trade. So the fact that, I was always very much tight on my risk, I was able to, make back everything plus in that one day from the carnage the previous 2 days. So that taught me that, position sizing, risk management is really the key to long-term success. You can be, right, but you better make sure that when you're wrong, you're not really wrong. So then, things started to change. I went upstairs, traded for about 7 years upstairs. Didn't really want to go with the trading group because you're beholden to the worst guy in the trading group can cost you money the way they had the structure on, all those JBOs back then. So then kind of morphed into a combination broker and, trading my own accounts and a little managed accounts. And I think that's really was the sweet spot until brokerage became, there's no money there, right? Because there's no commissions. The old fashioned brokers really are dying on the vine unless you can charge maybe a management fee. So then it kind of morphed into more just a, trading for myself, prop trading, managing some accounts, and then providing, advice to different web services and starting consulting firm Delta Derivatives and Option Analytics.
Gotcha. So what do you do in a consulting firm, right? Are you reaching out to different institutions in their trading, or how does that work?
I wish it was, more institutional. Those guys usually, the big boys have their own guys, right? And that's, but I mean, there's a lot of small funds out there that, it's kind of a niche opportunity. And most of them, it's providing a, avenue for a different kind of, trade that they're doing. And I do a lot of overlays for them. So a lot of my vol arb is basically on top of their core strategy. I started years ago with a pipes fund that was running into trouble because Citadel got into their space, and we know what happens when the big boys step in, the margins all shrink. So I started doing just a simple vol arb overlay on top of their, strategy, because mine doesn't take much as far as margin requirement to do. And they had plenty of, margin to use up. So it was non-correlated. It worked out very nicely. Unfortunately, they had to close down because the main strategy went bye-bye. So I continue that on to this day. So really it's providing consulting on not only, maybe if you want to do some options against your stock portfolio, the best way to do it, but here's a strategy you can do right on top of it, generate some non-correlated alpha. And if I can add, 125 bips over the course of the year to the overall fund, right? And I'm using, say, 15% at most of their AUM, then they love that, right? Because that will put them ahead of the game. And at the end of the day, if you can beat the guys in your space, that's how you get more money.
What does vol arb mean to you? You've mentioned that a few times now, and I just want to make sure we're on the same page.
Yeah, volatility arbitrage, it's a, really kind of a simple concept with a fancy term. So what I look to do is take a look at the volatility surface, so all the options. And implied volatility is just a fancy way to say the price of the options. So if all of a sudden to use, say, Apple, for an example, the 145 calls are being bid up, right, because there's a big buyer out there, I will go in and sell those and then maybe hedge by buying the 144 calls and the 146 calls, right? Do it in a delta neutral fashion, define risk. But the fact I can take advantage of someone's either overpaying or underselling, usually to get a big order done. And then once that goes away, everything reverts back. Implied volatility is absolutely mean reverting. Once it reverts back, I'd simply take the trade off and move on, right? In the meantime, I have absolute defined risk. So if something big happens before that reversion, I'm hedged and, feel comfortable with the position.
So let's go through that example again real quick. So you said if there's a big buyer coming in, they're buying up the 145 calls. They're expecting the market to go up. You were saying that I forget the strikes you mentioned, but you were saying you got yourself into a delta neutral position to work with that 145 call. Could you go through that one more time?
Yeah, sure. I'm really, excuse me, not directionally biased at all.
Yeah.
So, whether they're buying the calls, you can lean with them a little bit, but so I would just look for my best hedge. A simple one would be what's called a long call butterfly, right? So I would sell 2 of those 145 calls and then hedge with buying one of the 144 calls, right? One strike below, and one of the 146 calls, one strike above. And the fact that I can sell comparatively overvalued and then buy fairly valued, that's where my edge comes into play. In the reverse, yeah, if someone's selling, you just do the exact opposite trade.
No, I totally get it. Plus, on that trade, the risk on that is tiny because we're talking $1 wide, and you're probably scooping up. I don't even know, probably more than 50% of that width in your butterfly that you're selling there, right?
Yeah, and sometimes what I really look to do on stocks, say like Amazon and Tesla, is especially on out of the money options where they are very much price indifferent, right? They don't care if they pay 15 cents or 20 cents, right? I can get into these positions for a net credit where you have zero risk, right? You can hang on to it and just say, you know what, there's no margin requirement. You just hang on and, it's a free lotto ticket that they're actually paying you for. So I think out of the money options, because the big buyers out there they don't care. These big guys, don't care. A nickel doesn't matter to them. But to me, a nickel, if you do it in decent size and all day long, is everything.
Mm-hmm. So that sounds like a super small window that you could take advantage of something like this. How do you find something that happens that fast? Because I mean, if you're putting on this butterfly with the expectation of the vol to come back down, it sounds like this is like a half-hour trade at the most. Am I hearing that right?
Yeah, I mean, really, as long as, sometimes these buyers, right? So one of the keys is what's called open interest. So if there's a big open position out there, many times these guys have shorted these out of the money options from a while ago. They come in and they're really more price indifferent when they're buying to close, right? they just want to cover the position and move on. So if they have a big position, it might take them, a few days to get that position covered, right? If they have to cover 15 or 20,000 of these. So they many times come back here and you can kind of just, scan. It takes a lot of grunt work. I have scanners that I use. The firm that I'm with has some really high-end option scanners that are, really pricey. But, the Thinkorswim platform for one of my services, I showed them how to build a simple scanner to identify, changes in volume and implied volatility. So, you really have to do a lot of grunt work, but it's worth it at the end of the day, because when you find these opportunities, it literally can be free money, if you can get into these things for a net credit where there's zero risk involved.
Yeah, I understand completely. One of my things I used to do, I haven't done it so much in a while, but it was I would sell the broken wing butterflies. And then as soon as I could roll up that long leg to where it was a net credit overall, I would do that. Right. And I love doing that and teaching that to people, because I you're exactly right. It's like a lotto ticket. It costs you nothing to just hold it until expiration. And then you just let it fall out of the money if it happens to be out of the money.
Yeah, no, and that's a great trade too. Stuff like that is, people talk about, he's a great trader or whatever. Many of the times they're talking about guys who just speculate in a huge way and, hit a big home run, right? The really good traders are the guys who just day in and day out, do the work and continue to generate profits. And I hope, because the markets become so speculative that risk adjusted returns are almost passé now. But at the end of the day, it's very important, what your risk adjusted return is, not just what your return is, because, these guys who I've seen it on the trading floor too, they're here one day and gone the next day. So that's something that I certainly have avoided and continue to want to avoid going forward.
Well, yeah, for sure. And that's the whole point of the game, right? Is keeping your risk in check. As you mentioned earlier, you're defined by your big losses. And so you mentioned earlier about taking off like 1.5 times the credit. That's when you'd be looking at taking it off. And so that's where I think I know I went wrong on this early on, and I love sharing my losses, right? When I do my podcast, I've got nearly 600 episodes now. I'm not the guy who's like, oh, I win everything. Oh, I drive around in my Lambos and whatnot. No, I try and keep it as honest and open as possible, because a lot of the time people don't know what the risks are. And if you and I could have a conversation and I express that to somebody and it keeps them from making the same loss, it's worth my time to do that.
Absolutely. So, you're, at the end of the day in my trading career, forget about the vol arb stuff, but just, kind of, and I do have, my, yaya account, I call it, where I'm more speculative. But in that, I have absolutely more number of losses, right? The number of winners. But if I'm wrong, I have no problem getting out quickly. And if I'm right, and I think a lot of people fall into that trap too. It's the Kahneman Tversky, sort of thing, where, they're risk seeking at the wrong time, right? So let your winners run, let your losers, get out quickly, take care of themselves. And at the end of the day, it's about making money, not being right. I think a lot of people mentality wise fall into that latter trap.
Oh yeah. And that was for me too, right? I assumed that having the biggest win rate possible was all that mattered, but at the sacrifice of having these big losses that, never turned a profit for me. And, there was one year at the end of the year, I did a study on my personal trading account, and I was down on the year, and I was like, well, what happened? Right. And my trade, I thought was my number one trade, was iron condors. But I would indiscriminately put them on. I'd be like, oh, it's Thursday, iron condor day. Everybody gets an iron condor. You get one, right? I'd be putting them on everything. It didn't matter to me. And I had, and when I tell people this, they don't believe me. Their eyes kind of glaze over, right? But I had like an 80% win rate, because in theory, if you sell them far enough away, it should work out. But 90% of the dollars I lost came from that strategy. And it was because, the idea of putting it on, letting it go to expiration. If it works, if it doesn't work, whatever. But that's when the light went on in my head. Like, this doesn't work. It may have an 80+% win rate, but if I'm losing all my money doing this, obviously I'm not doing something right. And I think that the issue with selling options and selling spreads is the idea that you've got room, right? You talked about selling one standard deviation away. And I think that it lures in a lot of investors who don't really know how to manage risk. And I was in that camp. If a stock is at 100 and I'm selling a 110 call and the only thing it's doing is going up every single day, every day I'm looking at like, oh, I got room. Oh, I got room. Oh, I got room. And then at some point, I don't have any more room. It's in the money. I'm losing as every day goes by. What would you tell somebody who's coming into our world and they're seeing the idea of, oh, hey, I could just sell options and have these huge win rates. But in reality, it's not that easy. What would you tell somebody about that?
I always use the term, if you don't know where to get out, you shouldn't be getting in. So before I do any trade, first of all, I predefine my risk, obviously, in this instance with a spread. And second of all, I'll look on the chart and just say, when it gets to this point, right, I want to be out, or trim down. Usually I just get out of the trade. I have no problem. I'm not a fan of repair strategies or because usually if you're wrong, you tend to continue to be wrong. I always predefine my levels. If it gets to this point, I'm out, and I have no problem pulling the trigger. I think that's one of the most invaluable services I provide for the subscribers out there, right? Who I'll say get out of this trade. They'll do it. If they were doing it on their own, they would probably have that mentality you just talked about. Give it one more day, or it'll come back, or I also adhere to the Paul Tudor Jones philosophy of losers average losers. So adding to a losing position, especially with options, right, is a recipe for disaster. So be okay with, if you can't take a loss, you shouldn't be trading to begin with. And if you don't know where to take a loss, you better find out quickly, because the market will teach you that here's where you should have gotten out, but that was a while ago, and good luck now.
I heard somebody say one time that they feel people should learn to trade stocks before they learn to trade options. And it more, in my opinion, when I read that, it was more of the idea of the managing the risk. Because when you're selling options, like, you're already skewed in a unfavorable risk to return relationship, right? You're risking 4 to make 1 kind of situation. And when you don't have the practice of learning to trade the stocks and cutting your losers short and things like that, I think you're just naturally inclined, human psychology, to just let it work. And then, hopefully it comes back. And I think that there are people out there who really push that narrative. And I just don't feel like that's the case. I think you need to be very structured in how you manage your risk. And it should be paramount.
Should be at the forefront. And I hate to say it, but as these meme stocks have become so prevalent now, it's it's a YOLO trade every day, which, you only lose one should be, the YOLO thing, right, on some of these. And yeah, absolutely right. The worst thing you can do is probably have a trade go against you in options big time, and then have it come back, and you're like emboldened to keep doing it. I have no problem with the fact that if it goes against me and it does come back, you don't say, hey, I look like an idiot, right? You just say, I stuck. Be proud of yourself. You did what you needed to do, and you have enough money to trade the next day. So at the end of the day, risk management is key to everything out there. And I think options, because options are curved, not linear. Stocks are much easier to trade. If the stock's up $2, it's up $2. If stock's up $2, what are the options up? It depends on a lot of things. So and that curvature effect, that gamma effect, is where people can really get into trouble, especially on the short side.
Right. So where would you recommend somebody who is starting out, they want to manage their own account? How would you, hold them by the hand and say, okay, start here. Like this is the way to learn how to do it correctly. So you don't, because for me, it was unlearning lots of bad habits that I had learned before I really started figuring things out.
Yeah, absolutely. And I think, obviously learn the basics to begin with and understand them at a pretty deep level, right? Don't just jump in and, start trading without understanding, all the different components of option pricing. and the different kind of trades you can put on. But understanding implied volatility and how it, impacts option trading, right? I mean, I've seen a lot of guys in the retail world be right on direction and so wrong on implied volatility that they end up losing on the trade, right? Because they did the absolute worst trade. And it's tough enough to be right on the direction if you have a bad trade going in. So make sure you always include an implied volatility analysis in with your directional analysis. Or in the case of options, the nice thing is you can have a non-directional, outlook and, make what I call the dire straits trade, the money for nothing, right? If it just sits there. So options are really, I think, the last vestige that can provide an edge for people who know what they're doing out there. So get a good education, get your feet wet with some, simple spreads, a debit spread or a credit spread, and go from there. And then you can slowly build up, like you talked about the iron condors. But in a retail account too, I mean, you don't have the latitude to do some of the stuff that, the big, option books out there do, where they're managing, just a huge book of options. So there's really is only probably about 8 to 10 strategies that you need to know when you're trading options in kind of that retail account. And, as you go along, it's not as, they're not easy, but they're not that difficult once you get a grasp, especially on implied volatility.
To that point, I heard somebody say one time, for new traders, like they should just avoid options and learn stocks, like I mentioned earlier. But their point was, it's hard enough to learn how to trade options to begin with, right? Because there's so many variables that go into it. But to your point, exactly, that you can be right and still lose money, right? You're buying out of the money calls. You expect it to go up. It goes up, but it only goes up a fraction of what your call was. And you're looking at it, obviously as a new investor, and you're thinking, this should have worked, right? Everybody on Wall Street bets told me to buy these out of the money calls. Why is this not working? Right. And then there's, trading options. Gosh, I spent months thinking I knew how to trade, and then I blew up my account in 60 days. And then I spent probably 6 more months learning how to trade. And then I managed to blow up my account again after that. Right. And it was all risk-based, not controlling risk, not understanding how to trade and keep risks tight.
Yeah, and that's absolutely, and it's probably good for the long haul that you had trouble to begin with, because you wouldn't have kept, learning stuff along the way. And I think we miss, with the trading floor being gone, starting as a runner and actually talking to guys down there, seeing it and all that, provided invaluable experience for, that very notion you just talked about, where, you saw guys blow up, right? You saw the, true pros, how they handle it, right? It's kind of like, I'm a, big golf fan, right? You can watch the really good golfers, right? They go about their business in a certain way. The other guys who are, not so good, right, have a different approach. So, at the end of the day, options, like I said, aren't really, that difficult, right? People, I think, get scared off too early. But you got to put a little work into it too. And that's what I'm kind of not seeing in this market as we go into this more meme, all you have to do is buy this and hope it rips higher. And I've also seen implied volatility on these options in the, Reddit stocks. Guys who make the markets the first time through got run over. Now they absolutely lift the implied volatility, the price of the options, to ridiculous levels. People still pay it because they don't know what they're doing. And, there's a classic example, right, of, you can buy an out of the money call at over 200 implied volatility on these things. You had better have that stock continue to rip higher, right? Otherwise, you are just, SOL, to put it bluntly. And, and it's not the fault of the market makers, right? As a trader, you have the choice to always buy or sell an option, right? Tom Sosnoff always taught that to everyone. He goes, hey, if you don't like this, he goes, you can sell it. You don't have to buy it or sell it. You have the choice as a trader. That's a key thing. As a market maker, you have to react to, you put up a market, they trade against you, you hedge it. As a trader, you have the choice to, kind of wait and see. And I think patience also pays in trading. I think people early on get too, engrossed in it. I always equate it to like a big cat in the African plains, right? You don't run after every gazelle. You'll run yourself out. You wait for the weak gazelle, and then you attack.
I like that. Makes a lot of sense. Tim, I want to send people to learn more about you. So MarketFi is the best place for them to go?
Yeah, MarketFi is my longest one out there. As far as you can take a look at the stuff I've done, you can sign up. I send out, kind of weekly videos and newsletters, provide trade ideas. There's a couple other sites. The Adam Mesh Group is one that I provide trade ideas for. 2 services, starting a new one with stock news next month. So I like the fact, I think it's important for me to pass on, my too many years of experience now in the industry, but to pass it on in a way where, it's realistic returns with realistic trades. Certainly the option newsletter industry is fraught with all you need is $500 and you'll become a millionaire, right? If it was that easy, they probably wouldn't be telling you about it, would be my guess, right? So if the returns are good to be true, guess what? They are. So I think it's important to take a, realistic approach to option trading. You're going to have losers. You're going to have periods where you draw down. And that's kind of why I gravitated towards these sites, because they embrace that. A lot of the places out there go 180 and are like, oh, no, we just want to get you in and we're going to show you how to, be in Fiji within a year.
I'd love to be in Fiji within a year.
Me too.
Tim, thank you so much for your time today, and look forward to sharing this and hearing everybody's feedback about how much they've learned from you. So thank you so much for your time.
You better appreciate it, Christopher. Always great to talk options, especially with people interested in getting into it for the first time.
Perfect. Well, thanks so much, Tim. Have a great weekend.
You too. Take care.
Okay, so what'd you think? That was pretty incredible, right? Now, if you like that, that's only a taste, only a sample of what you're going to find in the full AI stock trading system. And I really highly encourage you to go and check this out. Obviously, you are interested in learning and how to trade, and that's why you're listening to this podcast. Now, I'm going to take and download my entire trading system that I use day in and day out onto you. And the only way I'm going to be able to do that is over at the AIStockTradingSystem.com. You're going to get phase 1, 2, and 3, several bonuses, and on top of that, I'm going to walk you through over a dozen trades that I put on inside of my account, holding your hand and showing you exactly how I got in, how I got out, how I use the artificial intelligence data, and how this could work inside of your own trading portfolio on a daily basis. So make sure you head on over to AIStockTradingSystem.com. That's AIStockTradingSystem.com to learn more and to get started and to download my decade plus worth of trading experience into your hands so you can start using the AI stock trading system today, the 5-step system to take the guesswork out of trading. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.